There's a pattern in history that has destroyed every global reserve currency. Not most of them, every single one. The Portuguese real dominated global trade for 80 years, then collapsed. The Dutch guilder ruled for 80 years, then fell. The British pound reigned for 105 years, then died. Each followed the same 7 stages. Each believed they were different. Each thought their currency was permanent. And each was wrong. The US dollar became the world's reserve currency in 1944. That's 81 years ago. And right now in 2025, the dollar is in stage 5 of the same 7-stage pattern. This isn't prophecy. This is mathematics, a sequence that has played out 4 times across 6 centuries. And the only question that matters is whether we are smart enough to see what's coming or arrogant enough to believe this time is different. Let me show you the pattern, the 7 stages that every reserve currency goes through, and exactly where the dollar sits right now. Before we go through the stages, you need to understand what a reserve currency actually is. It's not just a strong currency, it's the currency that other nations hold in their central bank reserves, the currency used to price global commodities, the currency that international trade is denominated in. When you're the reserve currency, every country needs your money. To buy oil, they need your currency. To settle trade imbalances, they need your currency. To hold safe assets, they need your bonds. This creates something called exorbitant privilege. You can print money and export it to buy real goods. Other countries have to produce goods to earn your currency. You can run endless trade deficits because foreign nations need to accumulate your currency for reserves. You can borrow at lower interest rates because global demand for your bonds is structural, not discretionary. Being the reserve currency is the ultimate economic weapon. It's why empires fight to achieve it, and why they collapse when they lose it. Now, here are the 7 stages, and as we go through them, you'll see exactly where we are. Stage 1. Military dominance and trade route control. Every reserve currency begins the same way, with overwhelming military power that controls critical trade routes, not just having a strong military, but controlling the pathways that global commerce flows through. In the 1450s, Portugal achieved something unprecedented. They mastered oceanic navigation. While other European nations were still hugging coastlines, Portuguese sailors were crossing open oceans. They rounded the Cape of Good Hope in 1488. This opened a sea route to Asia that bypassed the Ottoman-controlled land routes, and they militarized this advantage. Portuguese warships dominated the Indian Ocean, the South China Sea, and the Atlantic. They established fortified trading posts at strategic choke points: Goa, Malacca, Macau, Mozambique. These weren't just ports. They were armed fortresses where Portuguese cannons controlled who could trade, and on what terms. If you wanted spices from the Moluccas, you dealt with Portugal. If you wanted to trade with India, you needed Portuguese permission. They charged fees, imposed tariffs, and seized ships that tried to bypass their system. This military control of trade routes made the Portuguese real the currency that mattered. Merchants across Europe, Africa, and Asia needed reals to conduct trade in Portuguese-controlled waters. It became the currency of international commerce, not because it was backed by gold or economically superior, but because it was backed by cannons. The Dutch followed the same pattern in the 1600s. The Dutch East India Company wasn't just a trading company, it was a military power. It had its own army and navy. At its peak, the VOC had 40 warships and 20,000 soldiers. They conquered Portuguese trading posts, seized control of the Spice Islands, and established Amsterdam as the center of global trade. Dutch ships dominated the Baltic, the Atlantic, and the Indian Ocean. If you wanted to trade, you needed guilders, the currency of the power that controlled the seas. Britain in the 1800s perfected this model. At its peak, The Royal Navy had more warships than the next 5 nations combined. Britannia rules the waves wasn't poetry, it was fact. The British controlled the Suez Canal, Gibraltar, Singapore, the Straits of Malacca. Every critical choke point for global trade was British-controlled. The pound sterling became the global currency because British naval power made it impossible to conduct international trade without it. The United States achieved the same position after World War II, not just by having a strong military, but by controlling global trade infrastructure. The U.S. Navy dominates every ocean, 11 aircraft carrier battle groups, more than the rest of the world combined. The U.S. controls or has bases near every critical trade choke point: Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. This isn't about defending America. It's about controlling global commerce, making it impossible for international trade to function without American approval. That's stage 1, military dominance over trade routes. The dollar achieved this in 1945 and maintains it today. Check. Stage 2, massive trade surplus, the accumulation of global wealth. Once you control trade routes, you start accumulating wealth from the rest of the world, not through theft, through advantageous exchange. Portugal in the 1500s ran massive trade surpluses. They bought spices, silk, and porcelain from Asia using gold and silver. But they sold European goods, textiles, weapons, and African slaves at enormous markups. The balance of trade flowed toward Lisbon. Portuguese ships returned heavy with Asian goods that sold for 10 times what they paid. This surplus built Lisbon into one of the wealthiest cities in Europe. The Portuguese crown's revenues from trade were so large that they funded the entire government without taxing the domestic population heavily. The Dutch in the 1600s did this even more systematically. Amsterdam became the warehouse of the world. Goods from Asia, the Americas, Africa, all flowed through Amsterdam. The Dutch bought low in one market, sold high in another, and captured the spread. They weren't just traders, they were arbitrageurs on a global scale. The Dutch trade surplus was so enormous that Amsterdam was filled with wealth, the canals lined with mansions, the city's merchants richer than many European kings. Britain in the 1800s ran the largest trade surplus in history up to that point. They exported manufactured goods, textiles, steel, machinery, and ships to the world. They imported raw materials, cotton, tea, rubber, at prices set by British buyers. The terms of trade were dictated by London. The surplus built Britain into the wealthiest nation on earth. London's financial district handled more capital than the rest of Europe combined. The United States had the most dramatic trade surplus in history from 1945 to 1970. After World War II, America was the only major industrial power with intact infrastructure. Europe and Asia were rebuilding. The U.S. exported machinery, automobiles, steel, and consumer goods to the world. The trade surplus was so large that dollars flooded into foreign central banks faster than they could be recycled. U.S. gold reserves swelled. Fort Knox held over 20,000 tons of gold by the 1950s, more than the rest of the world combined. This is stage 2, massive trade surpluses, the accumulation of global wealth through advantageous exchange. The dollar achieved this from 1945 to 1970. But here's where the pattern begins to shift, because stage 2 doesn't last forever. Eventually, the reserve currency nation moves from producing goods to consuming them, from exporting to importing, from running surpluses to running deficits, and that's when stage 3 begins. Stage 3, reserve currency status formalized, the tipping point. At some point, the world formalizes what's already true. They officially adopt your currency as the reserve. This is the peak, the moment of maximum power. For Portugal, this happened in the early 1500s. European nations and Asian merchants officially recognized the real as the primary currency for international transactions. Treaties were written denominating trade in reals. It became the standard. For the Dutch, it happened in the mid-1600s. The guilder became the currency of choice for international contracts. Bills of exchange were written in guilders. Even the British East India Company used guilders for some transactions because Amsterdam's financial markets were the most liquid in the world. For Britain, it happened at the Congress of Vienna in 1815 after the Napoleonic Wars. The pound sterling was explicitly recognized as the global standard. International treaties, loans, and trade contracts were denominated in pounds. The gold standard, which most nations adopted, was effectively a pound standard because Britain controlled the rules. For the United States, it happened at Bretton Woods in 1944. 44 nations met in New Hampshire and formally agreed to make the dollar the world's reserve currency. Other currencies would peg to the dollar. The dollar would peg to gold at $35 per ounce. The International Monetary Fund and World Bank were created to manage this system. It was the most explicit formalization of reserve status in history. But here's what nobody tells you about Stage 3. This is the peak. This is as good as it gets. Because formalizing reserve status creates the seeds of its own destruction. Once you're the reserve currency, the world needs your currency more than they need your goods. So you stop producing goods. You start importing. The trade surplus reverses into a deficit, and the deficit becomes permanent. This is called the Triffin dilemma, named after economist Robert Triffin, who explained it in 1960. For the world to have enough dollars to use as reserves, and for trade, the U.S. must run trade deficits. The U.S. must send dollars abroad. But running endless deficits undermines the value of the currency. You can't be both the world's reserve currency and maintain a strong trade balance. It's mathematically impossible. So every reserve currency, once it reaches Stage 3, begins the slide towards Stage 4. Stage 4, deficit spending and living beyond means, the reversal. This is where the pattern becomes irreversible. The reserve currency nation stops producing wealth and starts consuming it. Portugal saw this in the mid-1500s. The trade surplus disappeared. Instead of exporting goods, Portugal was importing everything: grain from Sicily, textiles from Flanders, manufactured goods from across Europe. They paid for this with gold and silver from Brazil and Africa. But they weren't producing wealth. They were spending wealth accumulated earlier. The Portuguese crown's spending exploded. King João III spent lavishly on palaces, churches, and the royal court. Military expenses to maintain the empire drained resources, and here's the key. They didn't notice the problem because the money kept flowing. As long as Brazilian gold kept arriving, they could keep spending. But the gold wasn't infinite, and they weren't building anything productive with it. They were consuming. The Dutch in the 1700s followed the same trajectory. After a century of trade surpluses, the Dutch became net importers. Amsterdam's wealth made its citizens comfortable. Why work in factories when you can live off accumulated capital? Dutch investment shifted from trade and production to finance. They became bankers to Europe, lending to other nations instead of producing goods. This generates returns, but it's passive income, not productive growth. The trade balance reversed. They were importing more than exporting. They paid for it by liquidating accumulated wealth. Britain in the early 1900s faced the same reversal. By 1900, Britain was running trade deficits. They imported food, raw materials, and increasingly manufactured goods. They paid for this with returns on overseas investments, centuries of accumulated wealth invested in railroads, mines, and enterprises across the empire. The investment income was enormous, but it was extracting wealth created elsewhere, not creating new wealth at home. British manufacturing declined. Factories that had led the Industrial Revolution were closing or falling behind American and German competitors. The trade deficit grew every year, living beyond their means, financed by liquidating the past. The United States entered Stage 4 in 1971. That is when the trade surplus permanently reversed into a deficit. By the 1980s, the deficit was growing rapidly. By the 2000s, the U.S. was running the largest trade deficit in history, $800 billion annually. The U.S. imports far more than it exports: consumer goods, electronics, automobiles, textiles, everything from abroad. How is this financed? By exporting dollars, printing currency, and exchanging it for real goods. This works only because the dollar is the reserve currency. Other nations need dollars for reserves and trade, so they accept them. But this is living beyond means, consuming more than you produce. And it's the same pattern that preceded the collapse of every previous reserve currency. Stage 5. Currency debasement and money printing, the desperate measure. When deficits become unsustainable, when you can't borrow enough to finance spending, you debase the currency. You print money. Portugal did this in the 1550s. Facing deficits and declining trade revenues, the Portuguese crown began debasing the real. They reduced the silver content in coins, issued more currency than they had metal to back it. This caused inflation. Prices rose. Merchants began refusing reals or demanding more of them for goods. The currency's purchasing power eroded. By the 1570s, the real was losing credibility. International merchants started preferring other currencies for trade. The Dutch did this in the 1700s. The guilder had been backed by a strong banking system and conservative monetary policy. But by the mid-1700s, the Dutch government was borrowing heavily to finance wars and maintain their colonial empire. When borrowing became too expensive, they began inflating the currency, printing money to cover deficits. The guilder's value declined. By the 1780s, it was no longer the preferred currency for international trade. Britain debased the pound through 2 world wars. World War I forced Britain to print money and abandon the gold standard temporarily. They returned to gold in 1925, but at an overvalued rate, which caused economic pain. World War II forced them off gold permanently. By 1945, the pound was floating and losing value. Britain printed money to rebuild and fund the welfare state. The pound devalued repeatedly in 1949, 1967. Each devaluation eroded international confidence. By the 1970s, the pound was no longer a reserve currency. It was a regional currency. The United States entered Stage 5 in 2008. The financial crisis forced the Federal Reserve to print money on a scale never seen before: quantitative easing. $3.5 trillion created from 2008 to 2014. Then COVID hit. $7 trillion more printed from 2020 to 2022. The money supply expanded faster than at any time in American history outside of wartime. This is currency debasement, not by reducing metal content in coins, but by expanding the supply of fiat currency. And the effect is the same. The dollar's purchasing power declines, inflation surges. In 2021 and 2022, inflation hit levels not seen in 40 years. The difference between the U.S. and previous reserve currencies is scale. The dollar is global. When the Fed prints, it exports inflation to the entire world. Other nations watch their dollar reserves lose value. Their dollar-denominated debt becomes cheaper to repay, but their imports from America become more expensive. This stage is where confidence begins to crack. And once confidence goes, Stage 6 follows quickly. Stage 6, loss of confidence and search for alternatives, the breaking point. This is when the world starts looking for exits, when trust in the reserve currency erodes, and nations begin shifting reserves to alternatives. Portugal lost confidence in the 1570s and 1580s. International merchants began demanding payment in Spanish silver or Venetian ducats instead of Portuguese reals. Trade contracts began denominating in other currencies. Asian merchants who had accepted reals for decades started refusing them or demanding larger quantities to account for debasement. By 1580, when Spain annexed Portugal, the real was already functionally dead as a reserve currency. The annexation just formalized what markets had already decided. The Dutch guilder lost confidence through the 1700s. The French, British, and other European powers began holding more of their reserves in other currencies. By the 1780s, Amsterdam was no longer the financial center of Europe. London had taken that position. The guilder was still used in regional trade, but not for major international transactions. The shift was gradual but irreversible. The British pound lost confidence rapidly after World War II. In 1945, Britain owed enormous war debts to the United States and other allies. The pound was overvalued and supported only by American loans. In 1949, Britain devalued the pound by 30%. International holders of pounds lost almost a third of their value overnight. Confidence collapsed. Nations began shifting reserves from pounds to dollars. By 1960, the pound's share of global reserves had fallen from over 60% in 1945 to less than 20%. The transition from pound to dollar was complete within 15 years. The US dollar is in the early stages of stage 6 right now. The signs are everywhere. China and Russia began reducing dollar reserves in the 2010s. They've been buying gold. Instead, thousands of tons. China's official gold reserves have more than doubled since 2008, but unofficially, analysts believe they hold far more. Russia liquidated nearly all its U.S. Treasury holdings after 2014 sanctions. The BRICS nations, Brazil, Russia, India, China, South Africa, have been discussing alternatives to the dollar for trade. In 2023, they announced plans for a BRICS currency. It hasn't launched yet, but the fact that it's being discussed is significant. Saudi Arabia, which has priced oil in dollars since 1974, the foundation of the petrodollar system, began accepting yuan for oil sales to China in 2023. This breaks a 50-year precedent. Central banks globally are diversifying reserves. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. That's a 14 percentage point decline. It sounds small, but it represents trillions of dollars shifted out of dollar assets. The euro, yuan, and gold have absorbed most of this. Even small nations are reducing dollar exposure. Thailand, Malaysia, Indonesia, they're negotiating trade agreements that settle in local currencies instead of dollars. This is the beginning of stage 6, the world searching for alternatives, not because they hate America, but because they see the same pattern that destroyed every previous reserve currency. Endless deficits, currency debasement, loss of purchasing power. They're not waiting for stage 7, they're positioning now. Stage 7, replacement and collapse, the end. This is when a new currency rises to replace the old, not through formal agreement, but through market adoption. The world simply stops using the old currency and starts using the new. The Portuguese real was replaced by the Spanish silver peso in the late 1500s. Spain had conquered vast silver mines in the Americas, Potosí in Bolivia, Zacatecas in Mexico. These mines produced more silver than the rest of the world combined. Spanish silver coins became the preferred currency for international trade because they were abundant, standardized, and backed by ongoing production. The real, debased and declining, couldn't compete. Merchants refused it. The transition happened over 2 decades. By 1600, the real was irrelevant. The Dutch guilder was replaced by the British pound in the late 1700s and early 1800s. Britain's industrial revolution and naval dominance made the pound the obvious successor. London's financial markets became deeper and more liquid than Amsterdam's. The pound was backed by British manufacturing and trade power. The transition took about 30 years. By 1815, after the Napoleonic Wars, the pound was the undisputed global standard. The guilder was a regional currency. The British pound was replaced by the US dollar from 1945 to 1960. The transition was formalized at Bretton Woods, but took years to complete. Britain was bankrupt after World War II. The US held most of the world's gold and had the only intact industrial base. The dollar was the only currency that could serve as a global standard. The pound collapsed in a series of devaluations. By 1967, when the pound was devalued again, it was clear the dollar had fully replaced it. So what replaces the dollar? That's the question everyone's asking. And the answer isn't clear yet because we're not at stage 7. We're in stage 6, the search for alternatives. But history gives us clues. The replacement currency comes from the nation with military dominance over trade routes, a trade surplus, and productive capacity. Right now, that's not any single nation. China has the trade surplus and production, but it doesn't control global trade routes militarily. The yuan isn't freely convertible. China's capital controls prevent it from being a true reserve currency. You can't be the reserve currency if people can't freely move money in and out of your country. The euro is the second most held reserve currency, but Europe has deep structural problems: aging population, no unified fiscal policy, dependence on external energy. Germany has the production, but Southern Europe doesn't. It's a fragmented system. Gold is increasing in appeal. Central banks are buying more gold than at any time since the 1970s. Gold can't be printed, can't be debased, but it can't scale to handle trillions in daily transactions. There's not enough gold in the world to back the volume of global trade. Some analysts think the replacement won't be a single currency but a basket. Maybe IMF special drawing rights, a basket of currencies, becomes the standard. Or maybe technology enables something new, a digital currency backed by a commodity or algorithm. Bitcoin maximalists think crypto will replace fiat, but governments won't voluntarily cede monetary control to a decentralized system. The most likely scenario is a messy transition, a period of multipolar currency competition, several regional currencies used in different trade blocs, the dollar in the Americas, the euro in Europe, the yuan in Asia, gold for settlement between blocs. This wouldn't be clean. It would be volatile, unstable, and economically painful. But it's how transitions happen when there's no clear successor. Now let me show you why this matters for you. Why understanding this pattern isn't academic. It's survival. When reserve currencies collapse, it doesn't just affect governments. It destroys ordinary people's savings and wealth. Portugal's collapse in the late 1500s caused economic depression across the Portuguese Empire. Merchants who held reals saw their wealth evaporate. The Dutch collapse in the 1700s devastated Amsterdam's middle class. Savings held in guilders lost value. Investments denominated in guilders became worthless. Britain's collapse after World War II impoverished a generation. British citizens who held pounds, who had government bonds, who had pensions denominated in pounds, they all lost purchasing power as the currency devalued repeatedly. And the American collapse? It's happening in slow motion. Every dollar you hold is losing purchasing power. Since 2120, the dollar has lost roughly 25% of its value through inflation. Your savings, your paycheck, your retirement account. If it's denominated in dollars, it buys 25% less. And this is just the beginning of stage 6. If the pattern holds, if the dollar follows the same trajectory as every previous reserve currency, the next decade will see accelerating decline, more inflation, more loss of purchasing power, more nations dumping dollars. And when stage 7 arrives, when the replacement happens, there will be a moment of collapse, a currency crisis. The dollar could lose 50% of its value in a matter of months. This happened to the pound in 1949. It can happen to the dollar. So what do you do? First, understand that holding dollars is a risk, not a safe haven. A risk. The dollar is losing reserve status slowly now, but accelerating. Diversify out of pure dollar exposure. This doesn't mean abandon dollars entirely. You need dollars to live if you're in the US. But don't hold all your wealth in dollars. Hold assets that preserve value across currencies. Real estate, productive businesses, commodities. These hold value regardless of what currency is used. Second, watch the indicators of stage 6. Watch central bank reserve data. If you see accelerating declines in dollar reserves, that's confirmation the transition is speeding up. Watch trade agreements. If major nations start settling trade in other currencies, that's a sign. Watch gold prices. If gold surges, it means the world is fleeing fiat currencies generally. Third, understand that this isn't about politics. It's not about whether you like or dislike American policy. It's mathematics, the same mathematics that destroyed the real, the guilder, and the pound. Every reserve currency follows the same 7 stages, and the dollar is in stage 5, moving into stage 6. The pattern doesn't care about exceptionalism. It doesn't care about military power or economic size. It cares about deficits, debt, and debasement. And on those metrics, the US is following the script perfectly. Let me show you something that should terrify you: the timeline. The Portuguese real lasted 80 years as the reserve currency, 1450 to 1530. The Dutch guilder lasted 80 years, 1640 to 1720. The British pound lasted 105 years, 1815 to 1920. Each currency lasted roughly 80 to 110 years. The US dollar achieved reserve status in 1944. That's 81 years ago. We're at the average lifespan, and we're exhibiting every symptom of late-stage decline. Massive deficits, currency debasement, loss of confidence, search for alternatives. The pattern says what comes next. Stage 7, replacement. But here's what's different this time. And this is genuinely different. Not the usual, this time is different delusion. Every previous reserve currency collapse was regional. When the real collapsed, it affected Portugal and its trading partners. When the guilder collapsed, it affected Amsterdam and Northern Europe. When the pound collapsed, it affected Britain and the Commonwealth. But when the dollar collapses, it's global. The dollar is embedded in every economy, every central bank, every trade transaction, every commodity price, oil, gold, wheat, all priced in dollars. When the dollar loses reserve status, there's no part of the global economy that isn't affected. This means the transition will be more chaotic than any previous shift. There's no clear replacement ready to absorb the role. The scale of dollar-denominated debt globally, over 70 trillion in bonds alone, means that a dollar collapse triggers defaults across every continent. Emerging markets that borrowed in dollars won't be able to repay. Corporations that issued dollar bonds will face bankruptcy. Even developed nations that hold dollar reserves will see their central bank balance sheets implode. The systemic risk is orders of magnitude larger than 1949, when the pound collapsed, or 1780, when the guilder collapsed. This isn't just a currency transition. It's a restructuring of the entire global financial system, and restructurings are never smooth. They're painful, chaotic, and destructive to existing wealth. Let me be very clear about what I'm not saying. I'm not saying the dollar will collapse tomorrow. I'm not saying the US will become a failed state. I'm not saying you should panic and sell everything. What I'm saying is that the pattern exists. 7 stages, 4 historical examples. And the US dollar is currently in stage 5, entering stage 6. The timeline says we have maybe 10 to 20 years before stage 7, maybe less if the transition accelerates, maybe more if the US can somehow break the pattern. But breaking the pattern requires something no previous reserve currency managed. It requires reversing the deficits, stopping the money printing, rebuilding productive capacity. These aren't just policy choices. They're politically almost impossible because they require short-term pain for long-term stability. And democracies don't vote for pain. They vote for comfort, for stimulus, for printing money to avoid hard choices. So the pattern continues. Stage 6 accelerates into stage 7. And the people who understand this position themselves accordingly. They diversify out of pure dollar assets. They hold real assets. They watch the indicators. And when stage 7 arrives, when the replacement happens, they're not caught holding a currency that's collapsing. They're holding assets that maintain value across currencies. This is what the Portuguese merchants who saw the real collapsing did. They shifted to Spanish silver. This is what the Dutch bankers did when the guilder declined. They moved wealth to London. This is what the British elite did after World War II. They moved wealth to dollars and dollar assets. And this is what smart money is doing right now. Not all at once, not in a panic, but systematically, quietly, over years. The reserve currency death pattern isn't a conspiracy. It's a historical cycle documented across 6 centuries, 7 stages, 4 currencies, and now a 5th. The only question is whether you will see it before it completes, or whether you will be the liquidity that transfers wealth to those who did. The pattern is clear. The timeline is evident. The dollar is in stage 5, and history says stage 6 and 7 follow. Not as possibilities, but as probabilities, bordering on certainty. This is how reserve currencies die, not with invasion or catastrophe, but with mathematics. Slow, then fast. Ignored, then undeniable. And by the time everyone sees it, the transition is complete. If this changed how you see the dollar, the global economy, and what's coming, then you're starting to see the pattern. 4 times it played out, 80 to 110 years, 7 stages, and it's playing out again right now. Subscribe if you want to track stage 6 as it unfolds.